Hello again. Ask people in the street what they know about investing in emerging markets, and they'll probably say something like this.
Emerging markets are volatile.
They tend to be crisis prone.
And when crisis strikes, it usually spreads.
But having some exposure to emerging markets is important.
Because over the long term, emerging market shares outperform those in developed markets.
All those statements sound about right, but that's because investors have very short memories. When you actually study market data from 1900 onwards, as Professor Paul Marsh has done, you'll know the truth is rather more complex. Stand by for 4 surprising facts about emerging markets.
Developed markets over 114 years have given a return of 8.3 versus 7.4 on emerging markets. Emerging markets had a very bad first 40 years or first 50 years of the 20th century. For example, Russia, investors lost all of their money in Russia, which was an emerging market in 1900, and it submerged in 1917. And in the 1940s, emerging markets did very badly. If you look from 1950 onwards, emerging markets have outperformed by about 1.5% per year. A typical emerging market is probably no more than 10–15% more volatile than the average developed market. And so what's happened is that these emerging markets have gradually themselves developed, and as they've developed, risk has reduced. There's a very nice database by Carmen Reinhardt which shows for many, many countries, going back to the 19th century, the incidence of crises each year. We have used her database to look at 50 emerging and developed markets to see whether or not emerging markets are markedly more crisis prone. They certainly were in the 80s and in the 90s. Prior to that, it was roughly 50-50, and over the last period, since the millennium, there's actually been more crises in developed markets. People think back to 97 and 98, and they think contagion. They think of a chain reaction starting from emerging markets. When we looked at 12 major crises over the last 30 years, 6 that originated in developed markets and 6 that originated in emerging markets, the emerging market crises were not particularly contagious. They did not spread across to developed markets, but the developed markets were much more contagious.
For more on what we can learn from thousands of years of data from markets across the globe, why not check out this, the Credit Suisse Global Investment Returns Yearbook 2014. You can download it free of charge from the Credit Suisse website. Join us next time when we'll be asking Professor Marsh whether, after 3 years of disappointing returns, emerging markets are still worth investing in.